Hi everyone, my name is Anne. Welcome to our presentation. Today, Yongying, Zhangjie, and I will be discussing the topic of REITs, otherwise known as real estate investment trusts. Our discussion question is to give two examples of REITs and discuss their portfolio, performance, risk, and risk management measures, if there is any. Now, let me give a brief of what we will be discussing today. So, before we go into the examples straight away, I will first give a brief introduction of REITs and outline its main benefits and some things that needs to be aware of. Then, my groupmate Zhangjie will talk about our first example, which is Avalon Bay Communities REITs. After that, Yongying will talk about another example of Slate Grocery REITs. Finally, we will have a quiz to end up our presentation. So, what are REITs? Owning a REIT can be a great alternative to owning direct real estate. With a REIT, you don't have to deal with the hassle of managing tenants, dealing with repairs, or even building up a down payment, such as cleaning fees for that matter. Because it trades like a stock and you can simply invest what you want. REITs are typically classified into two categories by the type of assets: equity REITs or mortgage REITs. Equity REITs own a wide range of real property types, including office buildings, shopping centers, hotels, apartments, and much more. And these equity REITs derive most of their revenue from rents on those properties. Mortgage REITs may finance both residential and commercial properties and get most of their revenue from interest earned on their investment in mortgages or mortgage-backed security. In addition, REITs may be publicly registered and have their shares listed and traded on a stock exchange. Or they may be publicly registered but not have their shares listed or traded on a stock exchange. They may be go private, which is not registered and not listed or traded on a stock exchange. Now, there are actually many benefits to contain REITs in your investment portfolio, and one of the reasons behind that is for the high yield dividends that they offer. REITs are able to generate tons of cash from their monthly rental income, which actually makes them a great passive investing strategy. Secondly, buying into REITs is actually a hedge against inflation, because over time the price of a real estate, whether it be real estate assets or a REIT, it actually increases at the rate of inflation. And REITs have a lower than average correlation with stock market performance. So basically what that means is you will be able to reduce the volatility of your investment portfolio by hedging your stocks against real estate. They show to be great investment vehicles over a long investment horizon. However, there are some things that investors must realize before investing in REITs. First, as I mentioned before, one of the main benefits of owning REITs in your investment portfolio is the ability to earn these large dividend payments. If we take a look at our examples, Avalon Bay Communities REITs, they are actually paying a dividend yield at 4.2% now. For Slate Grocery REITs, they are even paying a much higher dividend yield at 10.4%. This is actually very common among REITs, because REITs are required to pay out at least 90% of their net income to their shareholders. And the dividends paid by REITs are actually not your typical dividends. They are actually known as distributions, which are not franked, so you do not pay corporate tax on profits. However, you will have to pay personal income taxes. For those investors who have higher tax bracket, may be at a disadvantage because they have to pay higher taxes. There's actually another thing that investors need to be aware of. Since REITs are required to pay out at least 90% of their net income to their shareholders in the form of distributions, So basically what that means is that in bad economic times, it could be more likely that these companies actually cut their dividends or their distributions. Their payout ratios are typically in the range of 70 to 90%. So, if the earnings decreased by a factor of 10 to 30%, like due to the bad economic, the REITs will typically not be able to sustain their distribution over the long term. But how likely would it be that their earnings drop that far? Well, it really depends on the type of REITs that you buy into. Considering the current situation of COVID-19, as the public health crisis worsened, social distancing measures and the business shutdown have affected the economy. We can see in this net REIT index, which is representing the investments in listed REITs, the total stock market return on listed REITs had a sharply decrease. All equity REITs had a total return of negative 7% in February, and even worse to negative 18.7% in March. In particular, rental REITs, commercial, and home financing mortgage REITs suffered substantial losses, about negative 15% in March. However, markets stabilized a bit in April and recovered some of the earlier losses with an 8.8% gain. It was because the positive performance of data centers and infrastructure, while have little face-to-face interaction with customers and may have an increased demand for digital communications. So, for commercial REITs that own large office buildings with triple net leases of about 10 to 30 years in length are probably a lot more shelter than residential with short-term leases. And it really is company-specific depending on how much cash they have on their balance sheets. So, companies with a lot more cash will be able to sustain their distribution a lot longer than companies without much cash. And these are some pros and cons about REITs that investors must be aware of. Now, Zhangjie will start our first example.